Hey, welcome to Oregon Cash Flow Pro. My name is James Barber, here to help answer all of your questions. Let's make sure this is working. See if we actually got this started. Okay, it looks like we are live. Finishing up our premiere video, and it should in the audience over here. So we'll give that a chance to happen. Let's see if that does happen. Okay, it does give you the opportunity to hit the button, play the next one. Steve, how are you doing? So we just finished our premiere of part 2 of the response video. I hope you guys got a chance to look at it. Am I still holding Tesla shares? Easy ask. No, no, I am not. Basically, I went cash at the end of 2020, and that ended up being a good move. I missed all the downside on those Tesla shares, and I just haven't felt like getting back into it. In fact, I'm just basically been really thankful for what I've been doing with my life insurance, the cash value of those policies, and not having to worry about the market in that scenario. So that's why you haven't seen me doing the live streams this year on the market onlys. It's I did for a while at the beginning of 2022, but basically just I've been trying to do a lot less of trading. So it was really hard for me to get out of my bad habits. And I didn't had no interest in being in a market that's basically dropping most days. It's been very erratic, right? Very volatile. Anybody follow us over from the premiere? Who do we have in the house here? So here to answer questions. You can ask me questions on anything here. Hopefully the discussion is going to revolve around Index Universal Life. That's the hope here. But I do want to let you guys know I am going to be doing live streams. I'm going to do a live stream twice a week. That's my plan from here out for the near future, where we're going to do live illustration designs and policy reviews. So if you have an illustration you would like to see, I'm going to do IULs on Tuesdays, and I think I'll shoot for whole life on Wednesdays. And these will be right around 11 a.m. Pacific time. So about 45 minutes from now will be the time that those are going to be. So if you have a policy that you want reviewed, if you have an illustration you got from somebody else, you want to see it, you can email it to me. We'll just review it live. We'll share our screen. We'll go through it. And as long as you don't mind whatever details are in the illustration, if it's a policy, I'm not going to share sensitive information as far as the policy. We just want to look at illustrations, whether it's for an enforced policy or if it's a proposed illustration that you're getting. We'll also do illustration design. So if you're just interested in looking at some numbers and you want to see an illustration on Allianz or Securian or National Life or North American or any of the other carriers that I have access to, I have access to quite a few, we'll be able to do that. And possibly I can bring on one of my team members who are going to take a look at one of the carriers. If we want to look at Pacific Life, I have a team member that can do illustrations for that one. What's happening? You joined the premiere late, but you're glad about the video response. Here's what I want you to watch and respond. Yeah, that'll be interesting. I'd like to see what he has to say. Mainly, I would just like him to acknowledge that not all value, all the people that are doing illustrations and selling IULs are coming from a place of sleaziness, which is what basically he liked to say in his video there, which is really why I thought it deserved a response. So, Jerry's Place, thanks for joining the community. Appreciate provide you with some value here. Let me know what you're looking for. You joined before this, but it does pop up on our chat. So you may not be here right now. But yeah, Carlos, did you see what I was just talking about, where I said to do live illustrations? One of the things I was thinking is when I do those live illustrations or policy reviews, I'll have one of my team members join us so that they can help us with those designs. So I was thinking of you when when I had that thought, because it might be a good idea if we get multiple people that are interested. You could be working on doing a design, because we're not going to show the illustration software itself. So we're going to have to do the design, do the PDF, and then that's what I'll share here. I don't want to have any issues with the carriers as far as showing their software illustration on a live stream. Yeah, I think that'll be fun. I think that'll be fun, and I know you like digging into the numbers. So any other feedback from the premiere? Any questions? Anything you think I didn't address, or anything you think I got wrong? Rashad, Chris is over dramatic. Yeah, that's that's one way to look at it. It does make for good video, though. I imagine that's why his channel is popular. You know, I tend to not bring a lot of energy. I'm mostly like, okay, educational. Let's talk rationally about this stuff. But like people that get on and they get excited and they've got this high energy, it can be a bit dramatic, but it's very popular for getting people to respond. And people that will respond, whether it's positive or negative, if you're in the comments, YouTube likes to share that stuff, and you'll inevitably uh, get some more algorithmic advantage. So anybody that made it through both of those videos, I congratulate you. There was definitely a lot of time spent on it, about 4 hours between the two in the response. It just seems like I don't know. It's kind of all building up. Everything I wanted to say in response to him. I've watched a bunch of his videos just criticizing IULs. I think a lot of it is warranted when it comes to some of the carriers out there, and definitely some of the salespeople out there. It's kind of like watching Dave Ramsey. You know, when he gets everything so wrong when he complains about life insurance and the costs and the agents. When he applies it to everybody, when he applies it to every agent that sells this stuff. There's obviously exceptions. I think we put ourselves in that position that we're the exception. We're designing really good policies at a minimal commission. And they have a really, really good chance to succeed and be a good financial product. Whereas most of the products being bought out there in the life insurance space are poorly designed for what we would call a financial product, something that we expect, a decent return on, or at least, some type of respectable return. And for the most part, Dave Ramsey's complaints are right. They're accurate for most of the products that are sold out there. And most people would be better off avoiding those things. So from a blanket perspective, it's easy for Dave to be very passionate in steering people away from those products, make them skeptical as to whether they should get them or not. They don't just say they can be a good product and then leave it up to the person to go find the right one and to find the right salesperson, knowing that 99% of what's out there is garbage, right? So I see the same thing when Chris is talking about IULs being bad. I like 99% of the products that are being sold out there don't match well. They're not great products. There are things inside of them that can change to such a degree that it can make it not a good product, even if it started out at what looked like a good product. Those are legitimate concerns. And so, for the most part, I don't have an issue when somebody complains about that stuff on a regular basis, which is basically what he does. I agree. And when you see people out there, you know, MPI is one of the things I think about. When you get salespeople that are not realistic in their expectations, they're positioning products in a way that I think is not going to be realistic that people can expect how to perform. It makes all of this look bad, and it sets unrealistic expectations. I think there's valid reasons to go out and complain and attack that type of approach. But when you lump everybody into that, that's when we got to push back a bit. Is IUL more for growth income and whole life just for storing capital? That is how I like to view it. Essentially, I like whole life as a good savings alternative, and I like the IUL as a good retirement type vehicle. So something that we expect to get a better growth from. We can pull more income out of it, especially early on in retirement when we're giving it a chance to earn that index returns above and beyond the loan rate. So if our loan rate is 5%, we know it's never going to be above that. And if we have a history of an index that performs greater than that, we're going to give it a shot going into retirement. We're going to give it a shot that it's going to perform at a better rate than that 5% so we can get some arbitrage. As we get farther into retirement, we're going to shift more to the fixed income or the fixed wash loan rate so we're not taking on the risks of a potential 0 year wiping out our remaining cash value, right? And the concern in that is after we get a lot of money in loans and we have massive loan charges that still apply even if there's no credit, right? That's where the risk comes in. We talked about that during that last video. So I do view the IUL as better for that purpose. You expect it to do better. And there's a history of it doing better. Whole life, awesome as a savings alternative. Incredible. We know what it's going to do. Then you're going to end up with some people that want to do an infinite bank. Whole life is generally better for utilizing like an infinite bank where you know what you can expect from it. You're not necessarily looking at something that's going to be a retirement vehicle. You're not necessarily interested in greater returns. You're planning on taking a function and you want the ability to borrow to go out and do other investments with all the expectations that come along with that and the safety that comes along with that, right? So there's a different purpose when we're looking at that. Whole life tends to be the better choice for that and the overall goals. Doesn't mean you can't use an IUL in that scenario because you can. It's just up to the person to decide which one they ultimately want to go with. Do you want to go for the growth, better growth inside the policy, or are you just focused on growth outside the policy? Dave, have I found any IULs with a guaranteed variable loan rate maxed at 5 by contract? F&G. You've seen AIG at 8.5 and it goes at 18. Fidelity and Guarantee is at 5. Yeah, Fidelity and Guarantee is the 5%. I use 5% in my example because Allianz is always fixed at 5%. So it's not a variable loan rate. It's always 5%. F&G is variable where it can be lower than 5, but it caps at 5. So F&G falls into my number 2 slot when I'm looking at products out there. I like the F&G product. I like their uncapped index option. I don't like that they reserve the right to add a spread to it. That's my only complaint there. And then, of course, it's a smaller carrier. So there's a little more risks when it comes to how much money do you want to have tied up with that particular company. It's been around for a lot less time, around 50 years. Whereas you've got 120, 130 plus years for Allianz. You've got an A-rated and high credit rating, high mid-90s Comdex score for Allianz, where F&G is like in the 60s for Comdex score. And the rating, it has gone up recently, but it's still like high B's, low A's. So it's not a top-rated carrier. So those are the only downsides with the F&G, in my opinion. Those present slightly more risk. They could put a spread in there. It does have a greater chance of going out of business. Now, F&G was a smaller company, a much, much smaller company for most of its life, up until last year or the year before, when they got bought by the National Fidelity Title Company. So now they've got the backing of a much bigger company. And that's when we saw the credit ratings jump up on it. So it was in the solid mid B's for a credit rating until they got purchased by the National Title Company. So I hope to see some good things from them in the future. Rashad says, you have an IUL policy. Not sure if it was structured correctly. You want to be able to borrow money to continue your note investing, stock investing. Can we review it and change it if needed? Absolutely. So there's two ways you can do this. You can either schedule a meeting with me. I'm going to put my Calendly link in the comments here, so you can schedule it. Or I'm going to start doing a weekly live illustration design and policy review. And our first one is going to be next Tuesday. So next Tuesday at 11 a.m. Pacific time, so about almost a half hour from now, I'm going to do them live. So if you're okay with having your illustration shown on the interwebs in a live feedback review, then you can just join me there. But either way is fine for people that want to see actual numbers. If you want me to give you personal feedback and you respond right there verbally with me, sign up on my Calendly. Let's have a Zoom meeting. That's going to be the best way to do it. But for somebody who's just like dipping their toes in the water, just wants to get some insight, doesn't necessarily want to feel like they're using some of my time when I could be meeting with other people that might want to buy a policy. I don't want people to worry about that, but some people just naturally will. Maybe they'll be more open to utilizing the live stream option. So I just had that thought earlier today, and I decided I'll do live streams offering the live reviews. So either way is fine. To you. Dave says, thanks. You have a proprietary version of Freedom Equity called the IUL Freedom from F&G. Okay, cool. I'm not familiar with the proprietary ones. I know F&G does work to make some proprietary products that are only available to certain groups. And oftentimes those are going to be better than what I have access to. We don't have any proprietary products through my FMO, at least that I'm aware of. Part of that is because I think for a long time, my FMO was actually owned by Allianz. It's interesting. We could contract with like 30 different carriers, but it was actually owned by Allianz. It recently switched. It was like the last FMO owned by an insurance carrier in the States, and it's not anymore. So it's now owned by somebody else. I don't know who, but it essentially hasn't impacted my business to see that changeover. And there wasn't really an impact from Allianz either that I could see. There was like, it has nothing to do with why I like the Allianz product, that's for sure. It's just going to be different. Just going to be different. And I think that might be why we didn't have access to proprietary versions. So now that we're now owned by a company that actually does more actual life business across all the different carriers. Maybe we'll get a proprietary version of something, but I have seen some good proprietary versions of F&G that people have offered. So something to keep in mind. But I still have concerns about the F&G product that don't fix that because it's a proprietary product. F&G just bought out 30% of your FMO. Oh, that's interesting. That is interesting. So I always thought that I was told that Allianz owning our FMO was like the last one out there. So F&G just getting into one, that's interesting. And is that That must be why they have that proprietary product. Must be why they have that proprietary product. F&G shared the profits with the agents, unheard of in the industry. That's good. That's good. For some reason, Chris says you can't do infinite banking with IUL. Why is that? He's wrong. I mean, I think he I don't know why he would say that. It's absolutely, totally, completely false. The only reason that I can think that you would say that is because you want to sell whole life. The reality is, and even I think Nelson Nash says this, I think you can use almost anything for infinite banking. You can put money under your mattress, and that's your infinite bank. Is right under your mattress, the money that you've stored under your mattress. Is it a good infinite bank? No, because it's not going to grow. It's at risk of burning up in a fire. You don't get any other benefits to it, right? But it's there if you need it. You can use stock for your infinite bank. You can borrow against those, but you can only borrow a small portion, like usually 30 to 50% of the value, and you're at risk of a margin call. You don't really get any other benefits other than you're not interrupting the compounding growth, potential growth of your stocks, but you're also not protecting the downside. So the reason we like life insurance as the vehicle for infinite banking is because of all the benefits that go along with it. You get the death benefit, you get guaranteed growth, um, not necessarily guaranteed growth in an IUL, but you could. You get downside protection. That's a big thing, right? You're protected from creditors. So there's all kinds of things that we can access 95 plus percent of the cash value tax free. We get tax deferred growth. So, like, there's all kinds of reasons why cash value life insurance is the vehicle of choice for those of us in the infinite bank space. Now, what's the reason you could use why you can't use IUL as opposed to life? I don't know. I don't know why. It's still cash value. It's still protected. You still get a death benefit. It's downside protected. You're not going to be able to. You're not going to interrupt the compounding. You still have access to 95% plus of the cash value. All of those things still apply. You just don't get the guaranteed growth. So there's a slight difference between the two. Slightly more risk with the IUL, but you absolutely can do infinite banking with it. So I don't know why somebody would say that you can't do. I would say it's not the preferred choice for most infinite banking practitioners, but that's going to fall back into what are they trying to do with it. If you already own an IUL and it's got cash value in it and you want to do infinite banking, use your IUL for that. There's nothing stopping you from that. Your cash value in any life insurance policy, if you have cash value, it works like line of credit. That is the only stipulation needed to be a good infinite banking uh, vehicle. Rashad, you wouldn't mind a live stream of your policy. Cool. Well, email it to me ahead of time or during the meeting. That's fine too. Um, my email is james@oregoncashflowpro.com. So if you just email that to me either ahead of time and just say, address this live stream, or you can do it during the live stream that you attend. You may not be able to make the next one. Maybe you make one a couple of weeks from now. We can look at it anytime. So, but I'm going to do each Tuesday for IULs, and I'm going to do Thursdays for whole life. I think that's my plan. You had the proprietary product before the purchase. Okay. Okay, cool. Well, I'm interested to see how the purchase may affect things. In all reality, it shouldn't. It shouldn't really affect it. Although you might have some pretty good, retreats because it depends how much money that F&G is bringing to the table. But with my FMO, we get some pretty nice retreats. I get invited. I'm going to Cabo in June, and we get really nice hotels. They bring in really good speakers. They just invite the top salespeople across the nation for our FMO. I happen to be the top salesperson for our life insurance side, and so I get invited to those things. It's pretty cool. I always thought maybe it was because Allianz was our backer, but I don't actually think that's the reason. You do your own trips. Next one is Spain. All expenses paid. Nice, nice. Yeah, we're going down to Cabo. I've been to Florida and Arizona. They tend to keep it fairly local. I usually see like trips to other countries offered by carriers, not necessarily from FMOs. That's interesting. Yeah, we'll see. Maybe we'll get out to some other far off places one of these years. But it's a lot easier for our vendors to stay local. So basically what I found out is the events that we have are basically paid for by the vendors. So we get vendors that come in, they help educate us on their products. Um, we have really good speakers. Yeah, so it's pretty cool. Your leaders are older now. F&G Life buyout is their exit. Still offering 50% of profits to agents on all sales. Life buyout. I'm not familiar with any of that stuff. Sounds intriguing. Let's see. Sapinen says SBLOC could do it. Use risk of maintenance call. Share backed line of credit. Yeah. Yeah. I mean, there are some actual brokerages that will give you a line of credit also. I guess that you would call it an SBLOC. I don't know if they actually call it that, but it's essentially a margin loan. Yeah. You risk a margin call or a maintenance call. It also has minimum 100% guaranteed index participation rates. Currently, most indexes are close to 200 without fee. Nice. And for 1.25% can get to 350. Hey, that sounds really good. I definitely like uncapped index options. Love uncapped index options. So that sounds like a pretty good offer there. Chris, you looked into F&G, but their Comdex scores in the 60s. Yeah, it's in the 60s, like 64. Why you didn't go for it yourself? Yeah, it just presents an added risk. So maybe not comfortable if you're going to be putting in massive dollars into it, but if it's a diversification, like if you have a lot of money going into other larger carriers, I don't see any reason why somebody might not want to dip their toes into that. Put some of their money into it, see how it goes. Yeah, could be a good one to add to a portfolio. I wouldn't rely on it exclusively because of the credit risk. You were listening to Dave McKnight, who is the author of the book The Power of Zero. He doesn't recommend any company below 90 if you want to be released. Yeah, I mean, and because the biggest risk when it comes to cash value in a life insurance policy is the viability of that company. That company has to remain soluble for you to be able to be sure to have all of the guarantees and access to your cash value, and definitely not going to lose it, right? You want that policy to be around for many, many decades. So the higher the score, the greater the likelihood. So I don't have any issue with that. It doesn't mean you can't sell those products. Like I said, you just don't necessarily want to be all in on that as your only option, unless it's just not a big amount. We do have FDIC type of insurance coverage for insurance companies that happens at the state level. So if an insurance company does go out of business, some of your value is protected. But it's like the FDIC insurance. Not all of it will be implemented to a certain amount. So for people that aren't putting hundreds of thousands or millions of dollars into a policy, I wouldn't have any fear about owning an F&G policy. Dave says no fears the F&G life ratings will continue to rise. Massive backing from Blackstone. Others, very strict underwriting for insurance and especially on annuities. Not only that, but they're owned by the life national fidelity title company now too. So yeah, I do expect that the ratings will continue to rise. We saw them go up as soon as they were bought out. Since Allianz is good, what other factors would you consider to diversify across other IUL companies? So for the most part, um, we diversify to avoid risk, right? Um, Allianz is very, very safe in my what I see from Allianz is how they do business is very respectable. They they know what their costs are. They charge what they should charge, which is why we tend to see higher expenses in Allianz than in other carriers, higher cost of insurance, because they're charging you what they need to charge you to cover the cost of insurance. Because they charge you what they need to charge you, they give you more guarantees than all of these other carriers. They don't reserve the right to add an asset under management fee. They don't reserve the right to change the load fee. They don't reserve the right to change the loan amounts. They don't reserve the right to change the loan credits. They don't reserve the right to change the bonuses. All of those things will be available. The only thing that they reserve the right to change when it comes to their uncapped index options is the participation rate. They guarantee it'll remain uncapped, that those will remain uncapped. So because of that, we can see that Allianz passes on what they profit. When their general fund account does better, we see participation rates go up, we see fixed interest accounts go up. And their fixed interest account is at 5% right now. The only other carrier that I see with a very high fixed interest account is F&G, which is why F&G is in my number 2. I think they're very close when it comes to um, being very good to their clients and passing on. When their general fund does better, you're going to see better numbers. That's what I want to look for from IUL companies. Most of the other IUL companies out there, their fixed interest is 2 and 2.5%. That tells me they're either holding back or they don't have a very good general fund. That if their general fund is not as good, if it's not as strong, if they don't have as good of um, investments, then they're going to have lower caps. They're going to have lower fixed interest rates because they just don't have the performance to be able to send as much money to go buy in the options on the indexes. Their options budget is going to be smaller. The other thing that we see is that they make up for what looks like a lower cost of insurance with fees in other places. We see that with asset under management fees or account value fees. North American is the worst at that. They have a 1.25% asset value fee. That's huge. Keep in mind, they offer a bonus of 1.65%, but that's not their guaranteed bonus. They only guarantee the bonus would be 0.5. So essentially, if they need to, they could drop that bonus down to 0.5. You're still paying an extra 0.75 for an account value fee that's going into their pocket to help offset where they're not making as much as they should be in other places. So that was one of the things that I noticed is with Allianz, it's basically upfront. When I go in and I talk to their underwriters, I talk to their um, uh, actuaries. We understand, we get an understanding from talking to them about how they do business, how they calculate all this stuff, that they have a budget of about 5%. So the reason when we look at guarantees in a policy and you see a 5% guarantee for a cost to borrow on Allianz, and same thing with F&G, 5% guarantee cost to borrow. A lot of people think, what happens in a rising interest rate environment? What happens if the interest rate environment goes up to 10% from a bank or for mortgages or whatever, right? How can insurance companies loan money at 5%? Won't that hurt them? Won't they go out of business? Potentially, not at all. That 5%, Allianz knows that they have the ability to allocate that 5% to go buy index options every single year. It doesn't matter to them if it comes from um, their normal options budget, or if you take a loan and you pay the 5% yourself as that cost of insurance for a participating index loan. It doesn't matter. It's a wash. It's a straight wash. They're going to have that 5% to go buy index options. That's why they can make that guarantee, and we don't have to worry about it. Now, from a client perspective, I love knowing that 50 years from now, regardless of the outside environment, if I've built up cash value in my policy, I'm going to be able to access it at 5%. That's nice. Now, a lot of other carriers, they may cap out at 6 or 8%. That's not very attractive. You're going to have a hard time getting arbitrage if you have a 6 or an 8% loan rate. But at 5%, we've got a much better opportunity. That's what I want to see. I want to see that opportunity for arbitrage. Why would I do a participating index loan if there's a very slim chance that the index is going to beat it? Right? If my loan rate is 8% and the index is averaged 9% or 10%, like that's very little reward for the risk. But when we have a 5% cost to borrow and then we have an average return of 9 or 10%, that's much better. That's a much better proposition, in my opinion. So the other factors to consider to diversify, other than credit rating, what's the viability of the company? For the most part, I don't really worry about diversification. If I have an optimally designed policy and I haven't reached the scalability point from that carrier. So with Allianz, it happens to be like if you're between 18 and 50, $1.1 million. And that gives us a MEC limit of like 64,000 a year, depending on how old you are. But that's a lot of money you're able to put into one policy. I wouldn't really look to diversify outside of my Allianz one until I get past that point if I want to do more than that. Right? Because I'm going to get the best opportunity for growth in that policy at 1.1 million in death benefit. So I wouldn't cut that in half just to diversify and put extra money somewhere else. Because I think Allianz is strong enough to handle that much of my money, and I'm not concerned about them going out of business. Now, I do have whole life with other carriers. I have multiple policies. So all my eggs aren't in one basket to begin with. But if I'm starting out, I'm just going to choose one carrier that meets my needs right now at the time. If I look to add policies later, that's when I might consider diversifying. And we ideally will look for another strong carrier. We want products that have really good guarantees. That's one of the things I like to look for. I don't want a product that has the ability to change 10 different things inside of it down the road, because it's going to be potentially really hard to figure out what the heck are they doing in here if you're not making money. I want it to be really simple. That's why I like this Allianz one. I want it to be really simple. Am I making money or am I not making money? If I'm not, why? And I know if I'm not, it's because of how the index is performing. It's not because they raised the cost of insurance, not because they raised the load fees. It's not because they changed the bonus options. You don't have to pay attention to all that stuff every single year when you get your annual statement wondering, what do I have to look forward to this next year? So it's just the participation rate when it comes to the uncapped index options. That's what I like to see. Rashad, you're fascinated with the buy, borrow, and die. Yep. So IUL seemed really good for this. You see IUL similar to real estate as a growth asset. So buy, borrow, and die is like the backbone of cash value life insurance, right? But it can also work very good for taxable assets, like real estate, right? There's other things that it works as well. But basically anything that has an appreciating value. So I liken life insurance to real estate all the time. I have some videos out there on it. You should check it out. Um, they operate very similarly. We get a similar long-term growth average, appreciation average. Mortgage works the same way as just borrowing from your policy. You're accessing the equity, right? What I like about life insurance, you don't have to worry about tenants, and you don't have to worry about repairs. You don't have to pay property taxes on it, so it doesn't interrupt the growth that's happening with that product, right? You don't get to depreciate it though. So like there are some advantages that real estate has, but there's also some disadvantages. Passive dividends and options. You like cash value life insurance as bond alternatives and the money market. Yes, me too. That is that is a great place to look at it. And that's where I like whole life position. IUL can be good positioned in there as well, but ideally, the safety and the actual guaranteed growth that you're looking at or that you're getting from a bond or bond alternatives, whole life tends to work good for that as a substitute. But I completely agree. Completely agree. Chris, any banks you can recommend for getting an iBlock or cash value collateral loan for IUL policies? I spoke to a few banks. They say they were okay to loan 90% cash value collateral loan for whole life. But for IULs, they were at 65, 75% of the surrender value. So policy loans give you access to more cash in an IUL. Yeah, for the most part, you're not going to find an iBlock is attractive in an IUL. For the most part, the loan options from the insurance companies are great in an IUL. They really don't get bad. It obviously depends on your carrier, but a lot of them are in the low 5% or under for the last few years. And then of course our top ones cap at 5%. Those are generally the best options. Right now, iBlocks are terrible. Like I had an iBlock for my whole life policies, and where depending on it depends on your value, but generally you can get 95% of the cash value in a whole life policy. So with Bancorp, who I went through, there was another one that I used too. It was what was it? Coastal States Bank. So Coastal States Bank, Bancorp. There's a couple other ones that I have on the list. They'll give you access to 95% of the cash value in a whole life policy, but they don't do IULs at all. There is Bancorp is looking to expand into the IUL space. I did hear of one bank that was offering in the IUL space, but I didn't look into them because the borrowing options from the insurance companies are so attractive, and you don't have any obligation to pay the loans back. There's monthly payments that are due. All of those are a big factor when it comes to whether you want to use an iBlock or not. But we're in a rising interest rate environment, and the iBlock that I had went from 3.25% up to over 6.5. So I switched back to the insurance companies. I no longer have an iBlock, and I wouldn't even be looking at getting one right now because the rates are not going to be attractive as long as the Fed keeps raising the rates. So something to keep in mind right now. Everybody's going back to the insurance companies for their loans. Just not attractive from banks. Passive dividend. What are my thoughts on Curtis Ray's strategy? I have videos on that. I'm not a fan. I'm not a fan of how they pitch it. I don't mind the actual strategy itself as long as we have realistic expectations. And of course, we got to realize what type of risks we're taking on when we're using the cash value in our policy to just boost the cash value in our policy, and we're taking on more and more and more loans because you may not get the arbitrage that's expected. And as Chris pointed out in his video, when those loans get to be a large number, what is the 0 year going to do to you? You've got to be aware of that. Now, early on in the policy, when we're doing that, not that big of a deal. If you think that your income is going to be expanding and you're boosting your policy up with its cash values early on, and you can afford the interest payments. I always wanna be able to afford the interest payments, so I know that my cash value is gonna compound, but the interest is not gonna compound. So as long as we can afford those, I'm okay doing it. But I don't wanna get to a situation where we're down the road and we're borrowing out $15,000,000 and we don't have very much cash value to show for it. That's risky. Now, of course, what type of actual return are we getting? If we're getting a good return in the early years, then we're gonna be able to afford to do it long. So I do expect that we should be able to see some type of arbitrage with certain products. Now, Curtis Ray's strategy utilizes Mutual of Omaha, not a reduced commission product. You can't reduce the commission in it, so it's going to have higher expenses. Um, doesn't have really great index options, has decent loan options, but they're variable. They start out at like 4%, but I believe it can go up to like 8% or 6%. Let me see. What is my notes? Oh, I didn't take notes on that one. I haven't looked at that one lately. So it's like, I don't know, maxes out at 6 or 8%. Not good if those rates go up and you're relying on getting arbitrage. So there are definitely some concerns to think about when it comes to that type of strategy. Does it mean you can't do that type of strategy and be successful? No. In fact, I'm working with somebody right now. We're doing a very large policy that will be basically funded similar to that. But the client I'm working with makes a lot of money. So it doesn't represent a huge risk. And they are able to cover the cost of insurance for a long time, even when the loan costs get very high. Um, so you got to take all those things into consideration. You know, I wouldn't want somebody who makes $50,000 a year to end up having, $500,000 in loans in a life insurance policy. That's really risky. You know, if they don't have much cash value to go along with that, they have massive loans, that could be a recipe for disaster. So it's all going to be relative. We regardless of the product that you get, you want to be building cash value that you don't have to borrow from, so that you always have more growth than whatever the interest is going to cost. We don't want to get into a situation where we're leveraged to the hip on everything that we own in hopes of getting some small arbitrage. And I think that they push that strategy. I think that they're putting people into that position with what I see from Curtis Ray. Rashad, you remember watching one of my videos saying the ways to increase growth in the value of overfund the policy could use a line of credit, pay back with your income to speed up the growth in the long run. Yes, absolutely. And that's in the early years. We don't want to do that every single year in the policy. And we have to take on the big picture. Do we expect our income to continue expanding? Okay, what I like to point out is ways that we can use leverage to jumpstart things. But what we don't want to do is put ourselves into a position where we're taking on way too much risk. For the most part, if you're just max funding a policy over the first 5 to 7 years, and you're taking loans to do it, I'm okay with that. We're generally not looking to plug in millions of dollars in those first few years, right? We might be putting in, 100,000 or $200,000. In which case, a $200,000 loan, 5% interest rate is what's that? $10,000. $10,000 in interest. That's affordable. For a lot of people, that's affordable. If you just need to cover that interest on the loan, that's not even $1,000 a month. For some people, that's a lot of money. For a lot of people, they have that cash flow. They could do that. That's okay. That's an amount that they're comfortable with, as a risk. And if you can cover that, interest, the interest isn't going to compound, but the growth will. and that could end up being really good down the road. Now, let's say you do that, you fund it that way over the first 7 years, and then you just focus on paying the loans back. So then we pay the interest. Not only are we covering the interest, but we're also have a loan payback strategy. So we're gonna end up in a situation where we have compounding growth happening in the policy and our loans are coming down. I wouldn't wanna do it in that situation if we plan on borrowing for 30 years on the policy year after year after year and growing that loan over and over and over. That doesn't make a whole lot of sense to me. It represents too much risk. Some people may end up trying to do that, and they could end up in trouble. They could end up with a lapse policy and an unexpected and unaffordable tax bill. And that could absolutely happen with people that buy into um, some of the strategies pitched out there. Let's put it that way. He spoke to a friend who's a doctor. Hospital offered them a dollar split plan. Hospital pays 80%. He pays 20, all of it pre-tax. If he waits 5 years, distribution is tax free. Yeah, those are great. That's great. That's a good deal. Those are the kind of plans that are very, very good for employees. Yep. Most likely what he's paying is covering the taxes. Because there's going to be some of it that gets taxed. Although I don't know the exact design on his thing. He might also get a tax bill. Although you said all of it is pre-tax money. So that tells me that his 20% that he's committing to is probably actually paying the tax. Because um, there is going to be some income tax due, but it's generally on whatever the term insurance cost would be for that death benefit. The business could end up deducting the premiums that they're paying. And ultimately, when it ends up paying out, it should pay the hospital back for the premiums that they paid into it. The rest of it going to the doctor. Although some of these plans, when it matures, so in 5 years, when it matures, sometimes they'll assign all of it over to the doctor, but even still, they may reserve the ability to or the right to be the beneficiary that will pay them back for what they paid out at the beginning. That's one of the reasons businesses offer that type of stuff. The design they did for him is bad. Break even point year 10, policy expenses are high, not designed like you recommend. Yeah, so they got sold. They got sold. Uh, although I should say, most likely they got sold. I don't think people that are people that are in that space, they're not just selling one policy or two policies a year. They're selling a lot of policies. They're working with businesses that don't understand that things can be designed better. Target premium was 108. Yeah. So yeah. So the agent made $100,000+ commission on that policy in that first year. Um, they didn't need to. Who needs to make that much money, right? That's not the only policy. They're not only selling one or two of those policies a year, most likely. Um, if they are, and that's their business model, then maybe they have to design policies that way. Not everybody can sustain their business with a minimum commission design policy. So that's something that we have to realize. Not people that do bad, what we consider bad design policies, bad cash value policies. They may have other expenses that require them to have a higher commission. I don't have that. So I can design the lowest commission policies. But if I had to pay for leads and I had to go drive a couple of hours to service those leads like I did when I first started in this business, I would have a hard time meeting with people that are a couple hours away multiple times in the hopes to sell them because you're not going to even sell everybody. You're going to only sell a small percentage of the people you talk to, especially with the not optimized design. Um, you've got a lot of time invested. You've got expenses invested, all the driving. Um, you're going to need to make more money than whatever the minimum commission pays, which is oftentimes like, $1,000, $2,000. That's not a whole lot of money. And if you're spending all that time driving, you're not selling as many policies because I meet with people across the country. I'm not limited to one area. I don't have to spend money driving. Um, I meet with people via Zoom. It's all very inexpensive. I don't need to make a huge commission for my particular business model to succeed. And I do very, very well because of that. But not everybody will be able to. So I also recognize that. And if you look at my part four of the IUL series, you'll recall um, the worst end point of a policy was not the higher commission design policy. It was one that you didn't manage properly when you got older. So you can have a bad design, one that pays out a higher commission, has high expenses, and it can be successful. It's really hard though when the target premium matches the yearly. Fortunately for that person, the business was covering most of that premium. So, uh, man, that's a rough policy though. I have seen some bad ones. The worst policy I saw was a Pacific Life policy, which I think I put in a video. Um, Pacific Life policy, or I mentioned it in a previous video. The clients were putting in 40,000 a year. They were they were close to $160,000 into this thing, and they had no cash value. So they were 4 years into this thing, four plus, I think. So maybe it was more than 160, and they had no cash value. And the year before, just the expenses, I thought maybe it was because of surrender charges. But the year before, the expenses alone were over 50,000. They're only putting in 40,000 and their expenses were over 50. I was like, where is the money going? It was just a really bad design for the amount of money they're putting into it. Just crazy. Well, we've had a good discussion. We've went for about an hour here. I'm going to call it a day here, but we'll be back next week, uh, next Tuesday, for live illustration designs. What I wanted to do, what I was hoping to do today was actually to go through. I talked about doing a part three. I was actually going to go through and do the part three. We ended up with a lot of great questions that took up that time. So next Tuesday, I will do the part three live. We'll look at the different designs, matching what Chris had in his video, and we'll see what happens if we make some different assumptions. How does it affect the policy? Does it actually implode? Or can it survive? What does it take to manage that policy if we don't make 6% a year? I think all of those things are important things to look at. So we'll try and do that. If I don't do it prior to that, I might end up doing the video sooner than that. But if I don't, we'll do it live next Tuesday, along with anybody else who's interested in seeing their illustrations designed or reviewed or policy reviewed. So thanks. You're welcome, Chris. And yeah, appreciate you guys joining us. Hope you found it informative and educational. And we will see you next time. Take care.